We've got all the way to the case where you've got a fund, you figured out what it does, you figure out how to incorporate it, now you got to operate it. And first and foremost, when we talk about operating funds, is where's the deal flow come from? How do you source investees? So as John said in his piece, you got to look at about 30 companies before you pick one as an angel. At Fledge, we look at about 400 to pick 7. So we're a lot pickier. And at the bigger venture capital funds, they look at about 1,000 to pick 1. And so in order to find the winners, because you're going to put money on the line in a fund, you got to look at a lot more companies. You have to be able to find hundreds of choices for each investment you make. And then you have to figure out, once you're dealing with 200 or 300 or 400 or 1,000 applicants, and they'll come if you're investing in them. There's more companies out there than you know of as soon as you say you're writing checks. How are you going to get that down to a small number that your investment committee can pick from? And so dealing with that is a lot of work. The way you deal with it is just what we call due diligence. So who does the due diligence? If you're creating a fund out of angel investors, can you have them do it? Even if they're not doing the final say, can they do the first say? Can they help you screen and get down to a short list based on their interests? How deep do you need to go on each of these due diligence? So we saw a couple of charts and we skimmed past that pretty quickly. And one of them showed that when you do, I think it was 20 hours of due diligence, your odds go up by factor 2. Do you do 100 hours of due diligence? If you have enough angels, do you have them keep looking down this rabbit hole until you can find whether or not this company is more investable? There's no bottom to this hole. You could keep doing it for months.
Well, but there is a bottom to this hole, because there is definitely diminishing returns on due diligence. And the default answer when you do due diligence too far is no. And so It's a great way to do more and more due diligence and make fewer and fewer investments.
Yeah, and one thing I like about running a accelerator that invests is we do some due diligence to figure out who gets in, and then I always think about the next 10 weeks or 2 months in the program. That's 2 months of due diligence on a daily basis, and that's way more than any investor would ever do. And so by the time they come out of the program, we know them as if we created them from scratch, because we basically tear them apart and put them together from scratch. Okay, last few things here. Who sets the terms? The norm in the world of angel investing is the company sets the terms. Very few angels push back and negotiate those. They'll either be in or out based on terms and whether they like the company. And a fund will typically negotiate the terms, if not set them themselves. And a full-scale venture capital fund will set the terms. They send out term sheets. And so you got to figure out whether you're going to do that. And then are you going to invest? Are you going to be the only investor as the fund, or are there other funds? And if so, are you always going to invest in groups? And the norm in California venture capital is one VC will say yes, and they will write half the check. They will write the term sheet and say, we will take half the deal, and we'll introduce you to other funds to do the other half of the deal. And that is not the norm in seed funds, and it's not the norm I've found over in Africa. But it is, crazy enough, the norm that comes from the old days of venture capital in California, and it has a lot of uses, and I'm not going to explain too much about that, but just a little bit. So investing in pairs helps you get some other questions you may not have thought of as you do the due diligence, and helps you do half as much due diligence, or maybe a third less due diligence because someone else is doing it with you. Overall, if you ask them why they do it, they say it's to share the risk. And it's not quite true. It actually comes back from the days when they didn't have enough money to write the check themselves. So they had to do a syndicate, which may be true of your funds. But if you go the other route and you say, no, I'm going to invest myself, well, then you get more control. You get to set the terms, because you'll definitely negotiate that. You'll probably sit on the board. It means you get the first look whenever they're raising more money. I've worked with almost 100 companies now. They will always ask me for money first before they bother to go out and even think about asking other investors. In fact, they'll usually ask me for money before they even have the pitch deck done. And my response, no matter what they say, is, great, send me the pitch deck. And send me your latest update. And if you're investing alone, you're writing all the checks, you can invest in the winners again. You should get bigger rewards, but I haven't seen any stats on that. And the big question for your cities and your countries is, do you have a choice on whether you invest alone or not? And that choice is basically, are there any other funds that like the same stage and like the same geography and like the same everything as you? And if not, well, then you're going to invest alone. Once you've decided to invest, are you going to take a board seat? And there's a bunch of different answers to that. For an accelerator, the answer is no, because it doesn't scale up. For a seed fund, the answer might be, yeah, now I'll sit on the board, I'll help them set up a board, and I'll expect to get out as soon as the next investor, the bigger investor, comes along. Or the answer might be that, yeah, I'm going to invest. I'm always going to take a board seat. In order to scale that up, I'm going to ask one of my investors to take that board seat for me. Because last question on here is, how many boards can you sit on? The answer is really around 6. A single human being who is being an investor can handle being on 6 boards if they do a half-assed job, right? 3 or 4 is a real answer, but VCs tend to do 6, which is way too many. And you're going to have to expect, if you're going to go down this path of doing boards of directors, you're going to be teaching how to run a board of directors, because it's not a commonly understood skill. And so when the full-scale California VCs show up, they teach you what to do if you haven't done it before.